afternoon, everybody. Welcome to Trader Merlin Show for your Tuesday edition. Should be a fun one. It's tacos, it's trivia, and it's John Rowland going to be on our program today. We've got quite a bit to talk about. We're going to kind of keep it high level, look at the broader markets, and then work our way down into the minutia of some of these markets. And if there's something that you guys would like to discuss, talk about, or analyze, do us a favor. You can type it on into chat there, and we will get things rolling here right about now. So my guest, who was no stranger to this program, I used to work with him many years ago. He is now, I think, the education lead over there at barchart.com. He is a chartered market technician. We're going to talk about market analysis with Mr. John Rowland, CMT. Good to see you, John. How you been?
Hello, Merlin.
Woohoo!
How's it going, man?
It's been a while.
It has been a while. It has been a while. Been busier than a one-armed wallpaper hanger.
A one-armed wallpaper hang. I like that. It's a good one. Anything that stands out in your world that you want to share before we dive into the markets? Anything exciting? You've done some traveling. I know you got all kinds of content over at Barchart, which we'll discuss, but you know, I live vicariously through you for a while because you're always posting pictures of you skiing and the grandkids and exciting things. There's got to be something exciting going on to start with.
Yeah, not a boring old man right now,
boy.
you know. But I live through my grandkids now, so I do spend a lot of time with them. And you know, my oldest is 3 years old, and the youngest is about going to turn 1 year old, and he is just a firecracker. He's all over the place, so awesome. I love him. We share the affinity of Hot Wheels together, and I actually have
I was gonna say
a classic Hot Wheel. This is a 1960 Corvette that I actually played with as a kid, so we played with that together.
I was gonna throw a joke about your Hot Wheels, you know, from the '60s, but there really wasn't a joke there. It was a real comment.
Yeah.
You know, what's funny is those ones are like the really, really expensive ones. I was reflecting with a buddy of mine when we were younger. Star Wars had come out, and we had all the figurines, and we'd literally melt them and strap firecrackers to them and blow them up. And I look at now how much an original Darth Vader's going if it was still in the box, like $100,000. Like, oh man, dang it.
Yeah, I have a what is this? This is a Maserati that I ripped the doors off as a little kid. If this was in pristine condition, it would be like a $30 car.
It looks cool without the doors, though.
Yeah, I mean, I think about all, you know, as a kid, we had the baseball cards too, right? I can remember I had a handful of Ernie Banks rookie cards. I don't know if you know
Ernie Banks,
right? Cub. And remember what I don't know if you did this, but we did is we put a clothes hanger on your bicycle and we made this.
Give it a motor, man. It was a motor for your bike. Heck yeah, I did that.
Think about all that money that you could be, you know, living off of now, right?
The things we know now that would have been different back then. Well, let's talk about the things we know now. Obviously, we have some fantastic market moves. Now, I'm not like percentage gain-wise, but just strength-wise. NASDAQ ripping the highs, S&P ripping the highs, Dow ripping the highs. What's your take on the euphoria for our broader equity markets right now?
Yeah, I have this show on Fridays that we talk about, you know, the markets, and we're calling it the everything rally, right? I mean, it just seems like nothing can go wrong. I mean, you just got to just throw a dart and you find the winner. But you know, I still believe the market feels like it wants to go a lot higher. There's certainly the path of least resistance to me seems is going higher. But I am kind of confused right now because if you look at like the sectors that have done really well, for instance, utilities. You know, we talked about this before we came out. And utilities is usually a sector that does well at the end of a market cycle, not at the beginning of a market cycle. But in the same breath, then you look at materials or consumer discretionaries, which have done really, really well in this potential new low interest rate environment. So those are ones that usually do cyclicals, do really well at the beginning of a market cycle. So I'm really kind of confused here about, you know, which sectors or where I want to put my money or where I want to place the money. So maybe this is a kind of a new morphing of a new economy that is based on, you know, this more of this AI hype, and that what we're seeing is that there is a much stronger segment of the consumer, maybe more older folks like myself, who have accumulated a lot of their wealth. Yeah, I think there's some pressure on the mid and lower income consumer. but maybe we're making up for what they are struggling to keep up with, you know.
Yeah, let me bring up the sector rotation model here for everyone at home, just to kind of understand what John was talking about, because to me this is very relevant, and this is kind of one of the issues I have with trading and investing from textbooks, because this is a textbook image. This is what the utopian perfect view is of the markets. And we talked about this with the Super 8 days that Thomasina asked about in the program the other day. Those Super 8 days were this historical, the last day of the month, and then those next 4 plus the middle 3 days of the month were like the most positive months because of money flowing into 401ks. Now, as people know that model, it changes because they become more anticipatory. They're trying to jump the gun, and then now it's the last 4 days of a month and the first day of the month. With these models I'm showing you here, this is what they've historically have done, and this is the norm. And as John is mentioning, you see here you've got two. You've got the equity markets in the orange curve, and then you have the economy in the blue curve. Well, as the market's in decline, you see that's where these ones become in favor. At the bottom, really getting near the bottom, or certainly in the steep part of the downtrend of the stock market, that's when utilities are doing rather well, right? Now, it seems to be the opposite, because the equity markets are at the peak, or at least the peak for now. They're really trending real strong. That should be materials, industrials, and energy at the peak. And as John mentioned, it's kind of the everything rally. I mean, I could bring up real estate and financials and utilities and healthcare, but utilities, as you guys have seen here, is hands down the strongest. It just keeps on. Oh, this isn't utilities. Let me go XLU, excuse me. Consumer discretionary wasn't bad either. But utilities looking absolutely fantastic. And it's difficult because you have this mindset of this is what the market's supposed to do. The market's supposed to have strength in utilities when the stock market's at the bottom. Therefore, this could be the turn of the market. But it's disconnected now. It's broken.
Yeah, some of the pieces make sense, right? Because utilities pay dividends, and in a low interest rate environment, dividend stocks should appreciate, right? But what we're seeing is if you go inside the XLU sector and you look at the components of that sector, some of the utilities that are doing really well are not really high dividend yield utilities. They're not your father's old-fashioned coal-burning smokestack, Dukes and Con Eds of the world. These are the new wave utilities, those that are into, let's say, nuclear. Look at the deal that Constellation just did to restart 3 Mile Island and sell all that power to Microsoft. As we move from what we call the hydrocarbon world to the new green world, nuclear, solar, battery storage, right? We did a webinar back in June, and I had a buddy of mine who is in that industry, and he talked about where he saw the growth in the utility industry. And if you look at some of the top performers, you get like the Vistras, the Constellations. These are the ones that have been outperforming. And again, they're not your typical utilities. So again, this is really is that a growth story? Is that an industrial growth story? Or is it about that just a continuation of that whole AI hype that brought, let's say the large mega caps up to all-time highs, which carried us here. One of the top sectors in the energy sector in terms of utilities is one of the GE that got spit off, Vernova. I think it's GEV. That stock is literally the company that makes the turbines, the windmills, right? And these power plants that uses natural gas. So again, this transition from, let's say, old coal to new green, right?
That chart that you just mentioned, the Vernova, that GE spinoff. I've got the chart up here. When they did the spinoff, which was on March 27th of this year, they were at 115. 115 was that price there, and today we're at 256 on Vernova. I would argue a pretty impressive rate of return. But I mean, I get it. I get the alternative energy play. I get that it's there's money looking for different things other than fossil fuels. And Liz made a good point. She says Next Era Energy is a lion's share of XLU. Yeah, it's almost 14% of that overall index. But it's funny because John was saying the next generation. Well, Next Era. I mean, it's written right in the company's name there. This is certainly one of the big pieces that's fueling into the upside. My question would be, how long are the legs in this one? If we look at the chart, if Vernova's supplying all the markets with these pieces and components at some point, it's like, okay, well, we've got enough of those out there. Now let's build the infrastructure to use all these tools and resources. I don't know. Seems like it's getting a little long in the tooth.
Well, you would think that, right? But, one of those stocks that I've been watching is MTZ. This is Mastech, and this is actually the company that builds the transformer lines, the highways of power that is going to connect these power centers to the grid. And again, you look at that stock is up 175% off of its 52-week low. And if you read their quarterly reports when it comes out, they say that they have so many orders that their backlog is 5 to 10 years out, that they can't keep up with demand. So I think the green energy transition is something that is coming, and you can't stop it. There's certainly a lot of support at the government level. There's a lot of subsidies at the government level. So I think those kind of stocks will do really well. The question, though, is the dividend aspect of it, that utility dividend aspect of it, is that going to change if, let's say, the dynamics of interest rates change? And one of the things that I'm kind of concerned about over the next year, next 2 years, is the refinancing of our public debt. And I think that crowding out of financing of debt will make the long end of the curve a little bit higher than we are now. I think we're like at 3.6%. I wouldn't be surprised if the long end of the curve gets back up to about 3.8 or even above 4 a year from now, as the Treasury tries to refinance some of this longer term debt. Yeah, the Fed can lower the short end of the curve, but that might be, the catalyst that puts a stop to a lot of these dividend type stocks.
It might be. That XLU, by the way, for everyone who's wondering, the 2.75% is what the yield is for XLU. So there's that. So the question came through. So you guys got to quit texting me messages. I can't look at them and do the show at the same time. Look it up yourself. All right. So we had that interest rate cut. I had a conversation with Bill Addis, who's my go-to bond expert. 50 basis points. Justified, unnecessary, or hey, let's do even more? What do you think?
Well, I was surprised. I thought they were going to do the slow and steady. I think the bond market kind of forced their hand. You look at the rates at the short end of the yield curve and the long end of the yield curve. We are way below where the Fed funds rate. So I think the bond market kind of forced their hand. I'm always concerned when the Fed cuts a large chunk in a very short period of time, that they might see something that we don't see. Certainly, maybe some slowing growth in the labor market, maybe, some slowing growth in, you look at some of different industries are not as strong as, let's say, for instance, what we just talked about, the utility industry. So that does concern me in terms of where I think the market can go. But in the long run, lower interest rates should be a stimulative to growth. It should be, some kind of relief to consumers, and it should help push the economy forward. The question is, do we have a little dip, a little recession before we actually start going back? And that, again, I can't answer that. Bill would probably give you a better feel about that.
I don't think anybody knows. We can all speculate. The hypothesis is, we're going to have some sort of recession. I mean, I can't imagine we pump $17 trillion into an economy out of nowhere and all of a sudden everything's just fine and honky-dory. But, I can't force my opinion that the market's going to crash on my trades. Otherwise, I'll be wiped out already.
Yeah, and again, I think that we have to stop, folks thinking about a market crash. I mean, you have to have certain catalysts or events that could line up that set up, and we really never really know what those are, right? Those black swan events. Certainly, there's a lot of political uncertainty. Certainly, there's some geopolitical uncertainty. I don't know, tomorrow, who knows? An asteroid could hit the Earth. Who knows? Whatever. But the point being is, we can't bet on a crash. All we can do is play the game that is in front of us, and the game in front of us is, for the longest period of time, is that over a longer period of time the market goes up. You just have to find the right pieces of the puzzle that are outperforming as that shell game, so to speak, is continuing on. And right now, it's been more about dividends. It's been more about um, the potential of new growth, right? Look what China is trying to stimulate their economy and what had happened today. You saw a lot of base metal jump today. Silver, I know it's more of a, some people think of it more of a precious metal, but it really is more of a, industrial metal. It's used in, it's used in power generation, I mean, and solar panels. But look at like a company like Alcoa or aluminum prices that jump big. The steel companies, Flora and Nucor, right? They all had big moves today on that anticipation of economic stimulation and growth, right?
Yep, absolutely. Well, the good news, John, is the asteroid's not going to hit Earth, so we don't have to worry about that black swan event.
Yeah, I read it's just going to go around.
It's just
right?
going to go around us. That gives it 720 feet long asteroid that's supposed to be circling us. I read somewhere that there's actually an asteroid, I think it's in 2025, that is like the size of a football stadium, and it's going to be passing over the northern part of the globe. And all the hotels apparently are booked, like in northern Norway, from all these scientists because they want to be there to see it, because you'll be able to see this clear streak across the sky. But we should be good.
Discretionary. There you go. Right, cruise lines and hotels.
That's right. Liz, it brings up a good point. She says now short-term rates are dropping. Dividend pairs would be more attractive, right? Yeah, absolutely. If you could buy a short-term, 1 month, 2 month, 3 month T-bill and get 5+%, that was great. Now all of a sudden that's going to drop to in the 4s and maybe start to drop even lower than that. So certainly anyone who's living off of a dividend play or income streams, these dividend stocks become much more attractive.
Yeah, for sure. Because you get the dividend, and if you get that growth story, which is something that we've in the past is not right. That's why utilities is always found at the bottom of a market cycles, because there's really not growth. It's more of a safe haven.
Right.
But now we're seeing growth in utilities. That is something we haven't seen, in 5 or 6 decades, right?
Do you think any part of that, and this is, okay, so my crazy hypothesis is that because of what happened with COVID and all the shutdowns, obviously they needed to increase costs to offset their expenses. So they had this opportunity to jack prices up and kind of offset the losses they'd incurred during parts of COVID. So they raised their prices significantly. I noticed my electric bill here almost double, all right? The rates have not dropped at all. When I look at, I think my average, I could bring up my statement here somewhere, but I think I'm at 33 cents a kilowatt hour, whereas like a year ago I was in the 20s. And those rates aren't dropping at all. So as the economy gets back to normal, as the business itself starts to get more efficient with what they do, they're keeping those prices really high. Therefore, their profit margins are going to get better and better and better because of those high charges that they're giving to us. And I don't see them backing off. We talk about deflation of prices. I can't imagine that my utility bill all of a sudden is going to drop 30%, or that my Habit hamburger, which used to be $8.63 for a number one combo meal, is going to go back from $13 plus back to $8. It's just not going to happen. They've got that locked in. We're paying it. So this might reflect that kind of new norm for these utilities, which is much higher cost to the consumers, and they're reaping the benefits.
As long as they can, like you said, the regulated utilities, as long as they continue to pass along, they get approval to pass that along. Yeah, but you're in California, bro, and you know how I always like to pick on you about that. You do have some unique things. There are a lot of government regulatory issues in terms about trying to accelerate the green initiative.
Yeah. We're a shit show. Just, you can say it. We're a shit show out here. I get it. I understand.
I'm trying to be politically correct and polite, but in a sense, yeah, you guys are kind of effed because of what is going on there. No, but this is not unique just to California. It is happening in a lot of other states where power generation is not keeping up with the demand. And just think about, now we're going to add these AI power data centers, which are consuming a lot more amounts of energy. So, places like Florida and Ohio and Virginia, Arkansas, where a lot of these data centers are being built. I feel sorry for those consumers because their power bills are going to go up as well.
Well, the good news, John, the good news is that Nvidia's, Blackwell chip is going to be far more efficient. So they are working on efficiency, but yeah, you're right. It's more and more power consumption. I mean, why aren't we going nuclear? I mean, come on, we shut down our nuclear power plant here in California. Is it too unsafe still? Like I'm in that nuclear category. Let's just build some nuclear power plants inside.
There's a lot of it. The Constellation story with restarting the 3 Mile Island started a whole wave of buying of some nuclear power plant companies. I think there is one of them. I'm not for sure the name of it, but they put in a permit to try to restart some of those nuclear plants. So I wouldn't be surprised if you see a wave of that continuing. Now, again, is there a black swan event in there if one of these mothballed nuclear plants has some kind of issue or something?
We've certainly gotten better and better at regulation and control systems. Here's Constellation Energy, ticker symbol CEG. Last couple weeks have been phenomenal for it. We've gone from like 172 all the way up over 160. So been a heck of a run there. But I think this will probably be a bigger discussion going forward is bringing back on more of those plants. I mean, if you can get one of those to generate so much electricity to offset the consumption, I think Bill Maher was screaming about cryptocurrency. Oh, it's 8% of the electrical consumption. It's ruining our environment. It's like, well, it's also providing a safe haven that's not penetrable by government, but that's okay. Different story there. All right. So lots to go on in the energy world. I guess I would be remiss if I didn't ask you your thoughts on. We'll start with crude oil and look at natural gas. I know you hate talking about those things, but that's your old stomping grounds. Crude oil, yeah. You're like anything exciting there that's noteworthy. I mean, crude oil has been on this nice downtrend for quite some time. Anything there that you see going on with crude oil?
Well, it did have a little bit of a pop just recently. I still think there's this issue with the geopolitics. What's going on in the Middle East. World global production has actually been rising. I know OPEC tried to bring down, rebalance the market by bringing down production, but there's this new player in the world, and it's called the American Quartet, and it's Canada, U.S., Guyana, and Brazil, and that production is accelerating quicker than OPEC or the OPEC nations can cut back their production. So that is kind of putting weight on the crude oil market. Also, you think about this transition as we move from hydrocarbons to green energy. Gasoline demand is down. That's because there's a lot more electric vehicles out there.
Yeah.
So that the old world energy, hydrocarbon is maybe not the investment environment that we want to look at. But in recent, we just had a little bit of spike. We had the hurricane in the Gulf Coast, which shut in some production. That helped a little bit. There's some issues with, I think it's Liberia is having some civil war issues. So there are some places around the world where production is falling. The key to the energy market, I think, is China. So if China has a growth spurt, which is its economy is talking
sputtering,
about, sputtering, then I think that is a good story. But I think if you want to look for opportunities in the energy space, I think you concentrate on those transitionals. Again, we talked about nuclear, but let's talk about LNG or natural gas, the pipelines that take from the wells to the processings, what we call marketing and gatherers. So you look at a company like Williams, is WMB. You look at Kinder Morgan, KMI. These are pipeline companies. Their stocks are doing well. Cheniere LNG is another one. That LNG issue. They take our cheap natural gas and they turn it into LNG and they sell it to China, Japan, and to Europe. So I think there's where you look for the opportunities in the energy space. And again, I think we talked about that market cycle, right? As we move towards the top of a market cycle, right? Well, energies has been the worst performing sector for most of the year, and maybe now this is where energy in a low interest rate environment will be the outperformer, and that's where I'm kind of looking for opportunities. As far as natural gas is concerned, again, the interest rate cut shorts helps promote short covering, excuse me. Saw that a little bit in the crude oil market as well. And again, we had a little bit of a weather just last weekend. It was 90 degrees in Chicago, and production was shut in from the Hurricane Francis. And now we have this another hurricane that is developing in the Gulf Coast. And this one is probably not going to have as great as impact on the natural gas production region in the Gulf Coast. But it's just that mechanics of getting the guys off the platforms and then restarting the platforms. It takes a little bit longer if there's another storm. So that has kind of been supportive to the natural gas market. If you look at the October natural gas futures price, it had a nice little 3-day rally over the last week or so. And again, I think that was more of end of the month expiration short covering. And I think really we need to see, again, global demand, domestic production being stabilized, and economic activity increasing.
I like it. I'm watching. I mean, I'm just bringing up the natural gas futures contract you mentioned, which had a great bounce over the last couple of weeks. But I mean, natural gas is just. Oh, I'm sorry. This is crude oil. Natural gas has just been getting crushed. I mean, it just keeps on going south and south and south.
But eventually, again, the market will rebalance, and if we do have this economic growth cycle that interest rates will hopefully stimulate, then a sector that does not perform well will immediately outpace the market. And we saw that briefly, I think in the beginning or the mid of spring. The energy sector was one of the best performing sectors. Remember at the beginning of this year, we had that anticipation that the Fed was going to cut like 10 times, right?
Yep.
No, it didn't happen, but the market kind of jumped the gun. I think something you've talked about in the past.
Yeah. Well, I was shocked, like most, that we cut 50 basis points. I'm kind of in the same camp as you. You should have done it calm and collective at 25 basis points. And right now the expectations, according to the Fed funds futures, are another 3 cuts. So 75 basis point cut by the end of the year. The expectations are November 7th, they're going to get another 50 basis point cut and maybe 25 in December. Crazy.
I think that's exactly what they're going to do. They'll probably what they want to do is they want to get that rate down. Now, again, we don't talk about politics here, and
it's hard to avoid it, man. It's hard to avoid.
Yeah, I know it's hard, but think about it. Who is the Fed supposed to serve? What's supposed to our general promote
full employment,
labor growth, and to help cut inflation. But who is not beneficial of a high interest rate environment, or is more beneficial of a lower interest rate environment? The Treasury, right? Mm-hmm. The Treasury has this tsunami of debt issuances that's going to come. So I think what we're seeing here is the Fed had to raise rates because inflation had gotten way out of hand. Now they're a little bit behind the curve. Now they're going to bring the short-term rate market down in hopes that when the Treasury goes to refinance, that we'll have a lower interest rate environment so that they'll save money. But I just think that there's just too much debt to refinance, and I don't think the long end of the curve is going to come down. What might see is that the Treasury will just kick the can down the road and continue to refinance on shorter rate timelines, right? 6 months, 1 year, 2 year notes.
Yeah, it's an interesting game that's being played with regards to manipulating the interest rates to benefit everybody, right? One, you want to benefit the consumer and help them spend and drive up the economy. On the other side, it could be detrimental to governments because they're servicing all their debt with much more expensive dollars. Not a good thing. And and then that could be another factor why we're seeing the dollar get pushed down. I don't know if you saw it today. The DXY, so the Dixie, that we were kind of traversing sideways, and all of a sudden we broke down below some fairly key levels for me. It has not broken down below them, and today we got that little peak down below that. We're right to 100 actually. You're sitting right at 100 on the DXY. We get a little bit lower, and next thing you know, you haven't seen these levels for a long time, and that tends to promote faster sell-offs, right? It's just going to be searching for that floor as it goes forward. Here's a 5-year on it, and you can see what I'm talking about. That low point that goes back. Where are we at here date-wise? Let me get the date at the bottom. to July of 2023. After
Right.
that, once you get below those levels, there's not really much area where you would identify as, hey, this is a demand zone. This is where things could bounce off of, and it's in the interest of the government to push that dollar as low as possible, right?
Yeah, expand that chart. I can't see your chart, but I'm going to assume just expand that chart out for like, a decade,
Okay.
right? And you can see how 100 is a very
Yep.
important swing level, right? Where it acts as a level of resistance for a long period of time, and then it has act as a level of support. So I agree with you 100%. And again, this is that whole, the interest, what markets, how markets will be affected by a lower interest rate environment,
Right.
and lower interest rates devaluates the dollar and really kind of promotes inflation. That's why I think that there's something wrong, right? We got this crazy cross currents that's going on, that the Fed has to lower rates, but maybe what they're trying to do is protect the job or labor market, and they're now going to let inflation go back, similar to what we saw a cycle in the 70s. But I agree with you. Below 100, maybe a quick pause around 95, but we could easily go back to, I remember when the dollar index, when it first started trading, it was like 87 or 88. So I mean, I don't know if we're going to go that low, but market remembers price though too, right?
Yeah.
So.
Yeah, absolutely.
So what would be the next leg, right? If we think about the dollar below 100, what would be that's inflationary, right? We talked about industrials, we talked about materials, right? And gold, right? That would be certainly beneficial to precious metals in the gold market. And you look at gold, boy, it's really acting like it is forecasting that the dollar is going to get weaker, isn't it?
Absolutely. And then, I don't have it added in my flip charts right here. I made a mistake. I should have had this all set up before, but I didn't add it all in. Unfortunately, yeah, gold and silver, just screaming to the upside. I'll bring up, I'll just do GLD, make it easy there on this one. But there's my gold chart, and you have, a beautiful trend. And we've been talking about on this program quite a bit, which is said, the trend is your friend to the bend at the end. And once we broke out of that sideways consolidation on gold back in 2023, great. Actually, we broke it earlier this year, and it's just been off to the races ever since. I don't see that changing. And then you have silver, SLV. Great moves up today. Actually, this whole week have been fantastic for silver. Why is my silver not showing up?
Hey, can you mind if I share?
Yeah, I have to enable it over here, which I usually do before. There you go. Go for it. It's all you.
All right, hang on.
You've got the flip charts all set up. I didn't set mine up here, unfortunately, so my apologies.
Yeah, so let's see. Hopefully you can see this screen. Can you see the screen with the GLD? Okay.
Oh, that's pretty.
Is that pretty? Party. You got a party. All right, so we did this on my show back in the beginning of the year. We talked about gold. And what I did was I took the low of 2018, and then what we had is a nice rally in the market. And then that was actually a period of dollar weakening. But then we had a sideways action during the COVID period. I call it the COVID consolidation. And then so I did a Fibonacci extension based on that low. And you can see that, right now, we are breaking out. We just got above the 100, and the next Fibonacci level is the 127. That puts the GLD at 256.64. Let's just round it up and say 257. So I think there is where we're going to. Now, if we looked at that in terms of the dollar price of the bullion of gold, it comes in around 27.50, 27.80-ish in that area. So we got another, $100 in the gold. So this is what I wanted to show you beforehand was, and I know you're a big silver guy. So this is the gold to silver ratio. And again, I'm showing over a decade of time. And you can see that we peaked at around 90 at the beginning of this year. We did get a little bit of dip. Silver did rally mid-year, right? But since then, there is this case that we could see the gold-silver ratio fall back into this range between 80 and 75. Now, if we think about a 27.50 gold at 75 gold ratio, that puts silver at $36.60. And at an 80 ratio, I think that puts it at somewhere around $34. So that is definitely bullish for the silver market. So I think there might be this rotation. I know you're a big silver guy.
Well, I'm a big
That
silver guy.
as
I love silver. The sad part is I don't hold it anymore because it got taken away from me in my call options. Damn it.
Yeah, yeah. So, I think um, there is an industrial play in silver, but also this rebalancing of the gold silver ratio where we could get back to, let's say, that 75-80 ratio, which would put silver, up around $35. I think where's it right now? Around 31, $32 or something, or is it still below there? I haven't really watched it
All right, you
as of recent.
SLV or sorry,
Yeah, the
it's
silver.
3240. 3240 is where the silver futures are at right now.
So another $3 to $5, another 10% from where we're at. So that would make sense in terms of what we're seeing in gold. So
Well, I like it. I mean, I am a holder of gold. I'm a gold coin guy, not necessarily a gold. I'll do gold futures every now and again, but I like to hold the physical coins and stuff like that.
gold. You're like the little miser. Do you rub it? My
I do.
precious.
It's funny. I like to. I have some standard normal gold American Eagles, but then I also have like some from the 1800s and stuff. I like those because you just kind of, I'll hold them and you just think this thing's like from 1850. Like, what was going on in the world at 1850? It's just this little monument of time. I like doing that. I know I'm weird. It's you. Hey, you got your little Maserati with the damn doors ripped off. I can hold a gold coin that's from the 1850s. Okay.
Yours is definitely worth more. Yeah, you think about it, right? It's like, he's like some like cowboy who stepped up to a bar and like buy drinks for everybody, right? It was a
Yep.
$5 coin, right?
So where and I don't know how true this is. We'll have useless trivia for a moment here on the program. When you were in your younger days, you used to walk up to the bar with your buddies and like, give me a round of shots, right? You know where the term shot comes from?
Yeah, in the old West, bullets were as worth as much as gold, and so that you could, if you had a lot of bullets, you could trade a bullet for a drink. How
Right.
about that?
There you go. Yeah, so it is true. I read it. I was like, that's pretty cool. You just put a bullet on there, give me a shot. I'm like, okay. Damn, there you
Yeah.
go.
Yep.
All right, so you have always been one of my favorite educators. You're always working and teaching and promoting and doing things like that. You have a webinar coming up that has to do with nudity. So just get ready, everybody. Talking about nudity on the show today. He's going to be talking about shedding light on naked puts. So get your minds out of the gutter. Nudity of options trading. That's coming up this Wednesday, just tomorrow.
Tomorrow, yeah. I took time off in developing my webinar to be with you today.
Wait, you mean you're not done yet?
Well, let's say I don't want to tell my boss, but no, yes. I'm always fine refining, see what I can do. I always try to like give real time examples. So when I write it like a week ago, the example that I wanted to use is not viable this week. And going into tomorrow's show, you think about Tesla is turning into a great naked put um, candidate because the implied volatility is so high, and you can sell an out of the money put and get a 3.5% return on, let's say, 24 days. I mean, where are you going to get that interest rate return, right?
Yeah.
So we'll look at we have a screener that looks at naked puts, and then I'll just give some kind of traders insight about what are some of the rules you might want to use to help you in your selection process, help you rank, what options or which candidates you want to. So kind of we want to look at it in a two-piece. We want to rank by potential return, but also we want to rank on the probability of not getting assigned. In other words, if we sell a put and the stock price falls. So there's a kind of a balance that we have to give and take. I can get a high return, but I might take on a high probability. So
Right.
I just got to give some guidelines to say, hey, how far out of the money do I want to be? Or what type of return should I kind of anticipate? What I call a minimum maximum potential profit return.
I've been in your shoes before where I was tasked, amongst many other things, to do a once a week webinar. And to come up with new topics all the time and make it engaging, is challenging. How have you been faring with that? Because you've been doing them. You do pretty much one webinar a week for what got to be a couple years now, right?
Yeah, I'm going on my fourth year. Yeah,
Fourth year.
this
Wow.
yeah, so it is difficult. So a lot of times we go back and we look at ones that we did 3 years ago and say, hey, can we, our website is always updating, right? I mean, if
Yep.
I look at our option suite where it was 3 years ago and where it is today, just a totally different um, animal. So again, going back and saying, hey, well, here we have all these new tools that we could, one of the new tools that we just brought um, to publication is options flow. This is the new uh, whatever you want to call it. Everybody wants to know where the option flow is,
Where's
right?
the
Where the money
flow?
flow,
Where's the
the
money flow?
flow,
Yeah.
right? So, that could be a multiple of webinars. But, in technical analysis, and that's really where my strength is there are so many different types of technical analysis, so many types of applications to technical analysis that it's almost endless, right?
Right.
And all those different variables. Again, technical analysis has to be taken with a grain of salt sometimes, but again, there is a lot of potential in terms of maybe not predicting where price is going to go, but in risk management. And as I know, that the real key to successful trading is not guessing where the market's going to go. It's guessing where they're going to go with the right risk management, right?
I don't
And
like the word guessing. I don't like the guessing implies I'm in the dark. So to me, I'm anticipating, right? Because
very good.
there's some factors that are behind it. And I made this point with my audience the other day. It's like, you can flip a coin 50-50 and you got a 50-50 chance. But if I flip a coin and heads is go long and tails is go short, and that stock is in an uptrend and I flip heads, I am already in a more profitable potential trade because I'm going with the trend, right? If I flip tails, which should be a 50-50 binary, profitability, and I'm in an uptrend, the odds are I'm probably going to lose because that trend is already against me. So it's those little, and that's obviously the most basic analysis you could make, but you start adding in stochastics, Bollinger Bands, on balance, volume, all these other pieces, and they may help you get, a percentage or higher probability in your favor. Great. As long as we can move that needle to give me a better chance, that's what it's all about.
Or with the right risk management, you flip a 50-50 chance, but if you're right, you get a 2-to-1 reward, not a 50-50 reward. And so then I can be wrong more times than I am right and still be a profitable trader, right?
Yep, exactly. Absolutely. Liz asked, you said, where can I find out John's Naked Put webinar? I actually put the link into the chat room for you, so you guys have that in the chat there. But if you go over here to barchart.com, I'll go to their homepage so you guys can see how I navigate it. It's pretty simple. You just go over here to where it says Learn, click on Learn, and you'll see upcoming webinars. First thing on the list. And if you go there, you'll be able to click and register for the upcoming webinar. We'll get a little description of what it is, reserve your spot there. And then
there you go.
And then you click on archived webinars and you have just hundreds to choose from. I mean, and again, a lot of this you might not be interested in, but you know what? Maybe you are interested in bull put option spreads. Maybe you are interested in looking at the EMACD screener, or maybe it's just successful risk management. There's a lot of great topics here that certainly will help you and improve your knowledge of the markets. And I think it's a great thing that you're doing. And I know how difficult it is because, like I say, I was doing one a week and I had a pretty good team. You have a great team behind you, so kudos to you and your team for sticking with the program. I know it's tough to do.
I know last week one of your viewers asked you to do a segment on gap trading. So just type in the word gap.
See, now I don't even have to do it. Perfect. The ones I don't want to do, I'll just have you do it.
There's 5. I really believe in gap trading. I think not only do gaps offer some unique trading opportunities. Not every gap are created equally. But also, I think there is this structure of the types of gaps that you can see that it can help you define where you are in a trend. And again, talk about risk management, right? If had a market that had a breakout gap, then a continuation gap, and then what we would call maybe an exhaustion gap, well, I'm going to be using much more tighter stops? Are you going to be using, more aggressive profit taking put strategies, for instance? But if I see a market is breaking out on a gap on high volume, well, that's where you jump on, right? That's where you're going to ride that horse until the trend or the bend in the end, right?
Yep. Just Margaret, I have the page up here. I did type in gaps. He's got 5 webinars on gaps, so that should appease you. Yes, it was Margaret that asked the question on yesterday's show, and I was like, I'll get to it. But it takes a lot of time not only to find the examples and to structure it properly, because there are so many different types of gaps. My big thing with gaps is they are an emotional event. You don't see a gap with nothing driving it. There's going to be fear,
Right.
greed, euphoria behind it. And while there can be some great trades made out of it, if you don't know what you're doing and you don't have good risk management and you don't have stop losses, you can get smoked on gaps, which is kind of why I'm apprehensive about going over those with some people, just because they can be pretty dangerous if you don't know what you're doing.
But think about when we talk about price, does price represent, right?
Yep.
Price really is the psychology or the emotion of the market, right? And so if you think about it in that way, right, a gap is the greatest imbalance between buyers and sellers, right? One side of that equation equals 0. So you talk about that emotional aspect of it. That means on the other side is that you have this major imbalance, buyers or sellers, depending if it gaps up or gap down. So that's where those trading opportunities come into play.
Yep. Love it. Well, you got a bunch of stuff there that's going to make my job easier, although it's not really a job when you do it for free. It's okay.
Well, listen, I know your style of trading, and when you give trading advice or structure a segment on your show about things that you can start incorporating in your trade plan, yeah, I know it's on par, and it's definitely something that folks need to pay attention to, because you are a successful trader, and I do really like your style of trading.
Thanks. And you as well, and I think that even though we both have our successes, we do things differently. And I think that's why it's important to talk to other guests and have different people on the program and, learn from other people, because obviously I don't think everyone's going to resonate with my style and do it the way that I do it. It's a reflection of my personality, and same with your style of trading. Your experiences are going to make you trade slightly differently, use different tools. So, yeah, got some good resources for you.
Different angles, as long as we get to the same result, right?
Same result, exactly.
And that is profitability, right?
That it is long-term profitability. All right, guys, if you want to get in touch with John, you can find all the information you need over at barchart.com. The Learn tab is where you're going to want to go there, and that's where you'll find the upcoming webinars as well as the past webinars. So go check that one out. He's got one tomorrow that you'll be talking about selling naked puts. That should be a pretty good one as well. If I wasn't busy, I would probably be in there. So, John, thank you so much. I appreciate you coming on the program. I know it's a time out of your busy schedule, another webinar event for you, but I appreciate you coming on. I look forward to having you back on again soon.
Always a pleasure, Merlin, and best of trading to you, my friend.
Thank you, too. All right, take care. All right, guys, that was John Rowland of barchart.com. You can find out more information, as I mentioned, by going to Barchart and getting all the deets there. Just a great guy, tons of experience, and always looking to help people get better at trading and investing. And, I love having people like John on, because he has a skill set and experience set that I've never been able to get to, which was I've never had the opportunity to trade as an institutional trader on a professional floor, meaning CME, NYMEX, and NASDAQ never had a trading floor, but, Deutsche Börse, these exchanges where you had an open outcry type of system and people with their vests and their numbers and all that stuff. I think that was a pretty cool experience. Now, I had a different experience. I was on the largest retail trading floor west of the Mississippi, which was about 180 people. But it's not the same. It was such a weird experience. I'm glad I was a part of it, but I love bringing on people like John Rowland and Craig Weil and Marty Dim and Michael Young. These guys who spent years on the floor of the Chicago Mercantile Exchange, actually in that environment. And to me, there's a different psychology, different mindset, different approach. And if I can learn from that and make myself better, then so be it. That will be my goal. John is always good. Yep. I wanted to bring him on more often, but, these guys all have busy jobs and busy schedules, so, I appreciate that he can take the time. Tomorrow's going to be a great show as well. We have a new guest, Tom Schneider of Ninja Trader will be on the program tomorrow. He is also a chartered market technician, so I've got two CMTs back to back. Tom and I will talk kind of similar picture, broad markets, but he's like, let's talk about technical analysis specifically, and he's got these 4 components of technical analysis that, from his perspective, are keys to success. So we'll get an understanding of who Tom is, kind of what his style is, and then we'll dive into more technical analysis, maybe at a foundational level, which I think will be pretty good for you guys. Overall. So that's going to be our guest for tomorrow. If you have questions that you want me to ask, you guys can always email them in at tradermerlin@gmail.com. I was going to go into a whole lot of market analysis, but let me just run through the top 7 because I'm not doing another hour show today. There's only one thing on this market that really has me got my eyebrow raised, maybe 1.5. The 10-year, no big deal today. You know, I don't see really that much going on with that 10-year, so there we go. This is the one that I mentioned I'm a little concerned with, which is that dollar index breaking down below the bottom of that box. Now, we've officially closed outside, which is the one that I'm concerned with. Yes, we broke it over here on the 18th of September, but we came right back in and didn't close. Now we've closed. That's a much more prominent feeling of closure outside of a zone. After that, you know, you've got this lower low going back down to about 99.75. Now, it doesn't seem like it's that far away. Excuse me, it's about 70 cents away, but that big of a fall could have some impact on the markets, and actually that would be bullish for your markets if this continues to go down here, and that feels like where we're headed. You look at what the Russell did today, you had 0.15% jump up today, although this is 0.15% move up. Still a little bit of hesitation from that double top we hit last Thursday. The S&P, though, breaking to all-time highs, historic highs, intraday closing highs. 57.92. That was only 1/4 percentage point. NASDAQ doing a little bit better. You know, notice where NASDAQ closed at. I had this yellow box drawn, been there for a while. We've hit it once. We came right back up into it. We've been in there for 3 days. And now all of a sudden we are right at the tippy top of this. So if that dollar keeps following, this thing's going to continue to move to the upside, and you'll probably find yourself at about that 20,600 mark, possibly by the end of the week if we get some big momentum move here on a breakout. Our top 3, looking at gold, was up 0.92%, which is just absolutely fantastic, following that pattern perfectly on the breakout of that sideways channel that we saw for about a month. Then Bitcoin, also 1.7% move up. This is starting to look better and better. If we get a close above the high from August 26th, which is 65,200, I think we're back off to the races up to 70,000 in a very short period of time. I don't know if you guys saw the testimony by Gary Gensler. Grilled again. Man, the lambasting that these senators are giving him is fantastic. There was one, Senator Torres, and if anybody saw it, stop me now, but Senator Torres, who's from New York, he looks at Gary Gensler and he starts right off. He just goes, Jared Gensler, so I've got two Yankees tickets that I sell you, and I buy 2 Yankees tickets, and I'm buying those with anticipation and that maybe they're going to go up in value and I can sell those for more in the secondary market. Is that a security? And Gary Gensler in true form is like, well, I don't want to answer to one point. He's like, no, you can, because this has actually been a court case where this was deemed not to be a security. So what makes a crypto project a security when these because the expectation is that ticket's going to get me into the ball game, into the stadium. Well, the expectation is that token that I'm buying is going to get me into something. In this one case was an animated movie, and that was deemed to be a security. Well, how? Same thing as baseball cards. So the heat is really, really building on Gary Gensler. My guess is by January we'll probably see him bye-bye once either president gets put in place. I think the pressure from the Democrat side will get him out, or the Republican will just replace him right away. Can I invite Todd and Larry on in the near future? Chio. So I'm working on a program. You guys let me know what you think. It's going to be outside of Trader Merlin. This is going to go back to Online Trading Academy's YouTube page. So it'll be Trading Academy's YouTube page. And let me know. Let me type it in the chat. Start a poll. It's going to be tough for me to type this. Would you? Let's see. I'm typing Outlook. So I'm typing this in quickly here because I'm trying to wrap up the program. And just so you know the poll, I said, would you be interested in a monthly market outlook show with other instructors? Like, let's say it's a panel discussion with Larry, Todd, myself, and Scott McCormick how many of you would like to see that. It wouldn't be on here. I'm going to do that through Trading Academy's YouTube page. Just so I think it's something I think needs a bigger format. And it's one of those things where we'll break it down by market segment. So I could come on and talk about digital assets. What do I see happening for the month of October? And Scott McCormick can say, hey, I'll look at commodities. Larry can say, I'm looking at options. Todd goes in the futures. I think it would be something that it's an idea I have. And now that we have this kind of clean slate over there with things that we can do, and nothing is off the table with regards to content creation, development, and building things other than resources at Trading Academy, I'm kind of excited about that one. It's just kind of one that I thought. Market says poop. Oh, you're talking about his new book. I thought you were talking about the idea. No, Steve, he would not. And, it's funny because that little scumbag is trying to get involved with all these other companies. He's trying to find his way in there so he can mess up something else yet again. So, no, he was have nothing. And I'll let you know, if there was any way, shape, or form that scumbag was going to come back, I would leave instantly. There's no way. No, Darcy, I'm not going to leave you. I'm just talking about potentially a program that is done on behalf of Trading Academy, not myself. This would be something that Trading Academy does. Just an idea I've pushed to them, and they seem to be on board with it. If it does get enough positive reaction and people want to see it, which I think would be, look, getting an idea from Scott McCormick about what the month of October challenges may be facing us, whether that's news-driven, economic data-driven, or just chart-driven, great. You want to know more about all those different markets, it's just eyeballs and opinions and outlook, which I think is something that would be good. All right, you guys gave a 94% reading, so 6% you're like, nah, don't want to see it. Okay, that's fine. The good news is most of you are on board with it. So I'll let you know, and then probably it's going to have to happen soon. My idea was to do it by the 1st of October, which is not going to give me much time to prepare, build. I need to get, that's going to be next Tuesday. We'll see. I'll let you know if I can pull it off. It's going to be a tremendous amount of work to get that off the ground for a maiden voyage with all the instructors I want to get. But we'll see, and I'll let you guys know what that looks like going forward. But that's the plan. All right, and finally, the one I have not mentioned yet was crude oil. Again, you look at the chart here. It still feels like it's going lower. Even though we had an update today, a 1.69% move to the upside. Unless we break some of these swing highs, it's going to keep on drifting lower. Going to keep on going lower. All right, everybody, that's going to do it for me. I am officially staying under a 1-hour show. As you can see, I've got 58 minutes on the program today. We will stop right now. Again, Tom Schneider of Ninja Trader will be on the program tomorrow. I'm pretty excited about that one. First time for him to be on the program. I was on Jim Cagnina's program a while back, and it was a lot of fun just to talk to these guys. And traders love traders. So hearing from other traders, I think is going to be one of those things that benefits you guys dramatically. So we'll have him on the program tomorrow, probably about a half hour or so. Don't want to take up too much of his time, but if you have questions and things you want me to discuss with Tom Schneider tomorrow, CMT, email me, tradermerlin@gmail.com. Thanks, everybody. I'll see you tomorrow.